You may be asked to agree to continue, and I hope you will. My name is Steve Sleigh. I am the coordinator of this session, and I will moderate a conversation. It's been an interesting conference, kind of a long conference. We started actually last week with some workshops and sessions, but we're getting close to the end of the 73rd annual meeting of the Labor and Employment Relations Association. And this conversation today is a little bit off the beaten path for labor and employment scholars. And so I hope you guys find this interesting. The title is Putting Labor's Capital to Work. We had one other panelist who was supposed to be joining us, Heather Slavkin-Corzo, formerly from the AFL-CIO and the United Nations Principles for Responsible Investments. She got snagged by the Security and Exchange Commission, and she started there just last week, I think, or the week before that, as their director of policy, where she will be a highly influential person on a lot of the issues that we will be talking about today. So if you were expecting Heather, I apologize, but send her your well wishes to the SEC. We've got three great panelists today, Randy Kinder, Tom Croft, Keith Mestrich, and I went out of order there. It's actually going to go Randy, Keith, and then Tom. I will do a quick intro of each one of them before they speak. And without further ado, I'm going to turn it over to Randy Kinder, who is the president at the AFL-CIO's Investment Trust Corporation. He's worked at the ITC and the AFL-CIO's Housing and Investment Trust since 2002. He's got a deep experience in the field of managing labor's capital, and has an MBA from Maryland's Smith School of Business and a BA from Notre Dame, where he was also famous for other activities. And so we really welcome Randy to give us a sort of an overview of some of the activities the AFL-CIO is doing in the area of putting labor's capital to work. Randy, it's all yours.
Thank you, Steve. And by other activities, I hope you were including football.
Yes, indeed.
First off, thank you, for having me here, for inviting the AFL-CIO and the AFL-CIO Investment Trust Corporation to participate in this conversation, which is an important one. I want to thank the folks at the Labor and Employment Relations Association. I'm going to just, my role today is, I guess, to talk about a few of the vehicles of this principle of labor's capital to work, and show how they work in action, and talk about what it is we do and what we've worked on behalf of the AFL-CIO and its member unions. So I'm going to describe a few of those vehicles that we've created with investment partners to help the wages, I should say, the fair wages earned by union members, go towards building them building their personal retirement assets, and how that's done in ways that reflect worker values and create jobs at the same time. Now, I'm going to talk about three of the vehicles that are directly licensed by the AFL-CIO, but of course there are other things out there as well. By the AFL, the first one that the AFL-CIO put out was a housing investment trust, which is actually where I started my career. I'll talk a little bit about that, but I'm going to focus on the three other ones, as I said. But we aren't the only games in town on this by any means. You're going to hear from some other folks who've been doing this for a long time. Our friends at Amalgamated Bank. There are other groups out there. ULICO is another big one. National Real Estate Advisors and others who share our values and have been putting them to work for a long time. Again, we aren't the only game in town, but we, I think, have got some good examples for how this can work and work well. And frankly, there are new things sort of popping up all the time, as I would say Wall Street and other managers have realized that investing your values works, and that people want to see that happen. And also, I think, as other managers out there have realized that labor's money is just as green as everyone else's, and they want to get a piece of it. So I'm going to clunkily try to share my screen now. Bear with me. I apologize. Give me a few seconds, and we'll get going with the little presentation that I've got for you. There, optimize, and share. And now I'm going to turn on the slideshow.
Perfect.
Okay, we're in business. All right. So I'm going to start out by just giving a quick definition of who we are, who I am. The Investment Trust Corporation, or the ITC, our mission, we're a service provider. We were created to work with the retirement investment community, and we offer distribution, labor relations, and investor relations services. So we raise money. We make sure that the investments that we're tied with abide by whatever labor policies that they have adopted. And we work with the investors themselves to make sure that they understand what's going on and they get information on time and in the right way. Now, we partner with responsible investment managers who want to work with labor and understand our values and needs. This is a point of pride for me, just to share a little bit of my team. Everyone on here shares the values that we talk about, that I'm talking about, and what we're all talking about in this session. Most of the folks on this have been doing this for the bulk of their careers, or at least working with labor for the bulk of their careers. And I'm just really proud that we have a team that are dedicated to this, that could be doing many things in many other places, but believe in our values. Now, as I said, these fine people, they work with the 240 plus multi-employer and public pension plans that invest in the funds that we work on, and they live and breathe it. All the people on my team are the beneficiaries of Taft-Hartley plans, of union negotiated health and welfare plans as well. So we believe in everything that it is we do. Now, I'm going to show you a short video, God willing, that it works, that talks about, and I think you hear kind of from the mouth of one of the union members who benefits from our investments and things we try to do, both from work, from the work that he's doing, but also on the fact that his pension plan is invested. So let's see if we can get this to work correctly.
Perfect.
My name is Daniel Garcia. I'm with Pipe Fitters Local 597. I've been a member of Local 597 for 24 years. My father was a fitter. He had me apply, and that's where it went. Being a member of the union, especially 597, it gives me an opportunity to be part of a project that once it's done, I'll be proud of. I've been at Wolf Point for a little bit over a year, and my duties there are, as far as a foreman and as a fitter, is to install all the equipment that is going to temp the building. We installed all the stackables, the equipment. We tie into them. We rigged it. We actually laid out, and so on. The importance of what I do here is, as much as when you walk into a building and you want to feel comfortable and you do not want to be overheated or too cool, we are the ones that actually make that happen. That you're going to be comfortable as soon as you walk into a building. We produce that. We are part of that. Being a union member and working on these projects, besides giving me a comfortable living lifestyle, it has given me an opportunity to have experienced something that one day I could show my family and say, hey, I was in that project, I was part of it, and it looks good. Something that I would like to say about Wolf Point is that it's something different. I got to see a little bit of different things, actually being part of what actually was a hole in the ground to what it is right now. It takes pride. It feels good, and it's looking good. I believe the misconception that they have is that it doesn't take much to do what we do. But once they actually see how it's done and actually be part of it, they would understand that with the right training, you can make this thing happen, and it end up looking beautiful. One advice that I would give to somebody who's thinking of joining the union is that if you are interested in taking pride in something and getting the right training, this is right for you. Being part of a project that one day you're gonna drive up with your family and say, yes, I was part of that.
I love that animation stuff. Sorry about that. So Mr. Garcia's experience really encapsulates what we're doing. He's a member of 597, the pipe fitters in Chicago. As we said, his union pension invests into these vehicles that we're talking about, particularly the Building Investment Trust. So again, it's union pension dollars going into projects that benefit members through the returns and the job creation. Kind of a virtual cycle, or is it virtual? Sorry, a virtuous. I've got virtual on the brain. Virtuous cycle, virtuous circle, which is what we aim to do. So let me talk a bit about the fund that invested in Wolf Point that he was working on, the AFL-CIO Building Investment Trust. Now, first off, the definition: it's a bank collective trust for which PNC Bank is the trustee. Now, the primary objective is to generate, of course, competitive risk-adjusted returns. And we do it through the real estate investments that have the potential to offer the trust current cash return, long-term capital appreciation, or both. Got to make sure we get all the definitions right. And as a collateral objective, but the one that we enjoy talking about the most, BIT investments help create union jobs and promote positive labor relations. Now, the bottom line on that: returns for our investors and union job creation, both on the construction side and the service side as well. Some quick facts on the BIT. It's a core equity real estate fund founded back in July of '88. What that means, but core equity real estate invests primarily in the bigger markets on the coast and in the larger Midwest cities, the middle coast, if you want to call it that. And it is the only commercial real estate fund that carries the AFL-CIO's name. Now, it's important to note the differences in some of the AFL-CIO licensed fund strategies. The Housing Investment Trust, which I mentioned, focuses on affordable housing. The BIT is focused on commercial real estate. So both funds are interacting with the labor economy in distinct ways that both serve the needs of our investors, of labor. The fund, as I said, has been around for over 30 years, close to $7 billion in gross asset value, net around 5. Now, every one of the 248 investors in the BIT, every one of those investors are comprised of, all those investors are qualified pension funds and comprised of union beneficiaries. And there are currently 55 properties in the portfolio. Now, let's talk a bit about the results of these investments. As you can see, for the life of the fund, $7.5 billion have been invested in over 200 real estate projects since the inception back in '88, with a 6.5% annualized return. Real estate's long-term investment. BIT is a conservative long-term strategy on that. But let's talk about jobs a bit. Now, as you might expect, the BIT's helped to create millions of union construction hours, and it continues to, but that's not all. Now, the labor policies for the BIT call for all of the buildings in the portfolio, all the buildings owned by the BIT, to use, where available, union contractors for the servicing of those buildings. So right now there are over Right now there are over 300 ongoing service contracts with union signatory contractors on the portfolio. We also require that certain types of tenants, like grocery stores or healthcare facilities, have neutrality agreements that permit their employees to organize as well. So we got construction jobs, you got service jobs, and permanent jobs at the same time. Now, as you saw, maybe you were able to point him out on that list of the team, Lynn Fieldman leads our labor relations efforts. He's a 40-plus year IBEW member and leader. And his job is solely to make sure that the labor policies are executed in the way they're supposed to be. We take this work extremely seriously and are called on it every day. A little bit more on the portfolio. It's across the country, nationwide, diversified portfolio of assets, primarily in major cities, as I said, but it has all the major property types as well. And it's intended, and we have high occupancy rates, long-term leases, and diversified tenant base. Now, I want to show you some things coming up and ongoing. Wolf Point South. So the building that Daniel Garcia was working on in the video, I think at the time was actually the second building, which was the Wolf Point East. Let me make sure I get them right. That whole project in Chicago, which is right where the river kind of breaks off downtown, and Ullico is also an investor in. comprised of 3 buildings. The latest one, Wolf Point South, which is going up right now, is going to be the home of Salesforce. It'll be the Chicago Salesforce Tower, $815 million project, all told, under construction right now. Now, also under construction right now is the Waverly in Seattle. I think I've got some fun time-lapse video on that as well. Let me see if I can get that. There we go. So that's in Seattle. It's a 28-story apartment tower, downtown Seattle, joint venture between BIT and Greystar Real Estate Partners. And when it's completed, it'll generate approximately $208 million total development costs. Obviously, another million, several million construction work hours. There are about 200 workers on site there actually right now. We got 2 projects as well slated to begin later this year, one in Minneapolis at North Loop Green, and another in San Francisco called Cadence, which is the second of 2 projects that the BIT developed there. And of course, everything will be constructed with 100% union labor. So we'll talk a bit about the outside of construction and real estate investment, what we've been working on at through the AFL-CIO as well. Now, for years, the BIT, the Building Investment Trust, and the Housing Investment Trust have been pushing the labor economy forward in the housing and commercial real estate sectors through job creation and good return and market rate returns. Now, back in 2011, President Trump helped us launch or push the launch of something to really represent our values in the stock market as well, following similar strategies that have been done by the IBEW and our friends at Amalgamated Bank for years. Now, initially, the AFL licensed a single S&P 500 index fund back then. Now there are 5 different indices and currently about just over 13 billion committed or under management in this new suite of funds. Now, what they do, they offer competitively priced, with the low fee structure and the ability with the growth of assets to lower that fee even further. Now, these funds make sure that union investors, the owners, are able to utilize their voice in stock investments in ways that comport with our values. Now, our partners who manage the fund would tell you that index funds over time offer access to a securities. These index funds offer access to a securities lending program, increasing net returns to investors with better execution on trades and lowering trading costs and the like. Also, we're able to grow with our partners, Mellon, to add other indices over time as well. Now, as I alluded to, and this is the same thing that's been done in the past with Amalgamated and others, the proxies on this, again, are voted in accordance with the AFL-CIO proxy voting guidelines, promoting worker values. Now, the newest piece that we've been working on, I'll skip ahead here. As we talk about the BIT, the HIT, and the index funds, those are all set up for pension funds to invest into. The target date funds, which are coming to market very soon, will bring that the same level of promoting labor's values and fee consciousness and active ownership to individual investors as well. They're slated to launch a little bit later this year, hopefully in the next few months. And it's another way that the AFL-CIO is driving the union economy forward to make our investments fall in line with our values. Looking passive underlying strategies, proxy voting, trying to bring these things closer to actual working people so that they can make decisions on their own to invest according to their values.
Randy, we've got about a minute or so.
I'm actually wrapping up right now, but I wanted to make sure you guys saw these 3 ways that the AFL has taken an active role in licensing products to make sure that these things are working within our values as well. And with that, if I can find the button to stop sharing, there we go. I'll pass it.
Perfect. That's a great overview, Randy, and good graphics and a good story. I had the honor to run the Machinist Union multi-employer pension fund for a number of years, and we were investors in both the BIT and the HIT. And I'll tell you that those investments, when you run a pension fund, you're wake up every month in a cold sweat saying, can I pay 100,000 pensioners? Your job is to pay pensions. And that's the first, second, and third job. And if you can create some jobs for people outside of that, that's great. So both the HIT and the BIT helped us meet our investment objectives and created great jobs. So it really is a win-win for everybody. So a really fantastic job. And just put it into context, the institutional investor world, pension world in the U.S. has a little over $4 trillion in assets under management. Huge amount of money. They are market movers. And most of those pensions have a union voice, whether they're multi-employer plans or public pension plans with union representatives. So there is a union and employee worker voice that can influence over $4 trillion in our economy. So that's sort of the opportunity out there. And HIT, BIT, ITC is corralling a piece of that, and you guys are doing a great job. Let me turn it now over to Keith Mestrich. Keith is a friend, one of the most unusual bios you will see. Came up through the ranks of the labor movement, worked at the AFL-CIO, then went to work at the Amalgamated Bank, and very quickly worked his way up to become the president and CEO of the bank. I was honored, and I continue to be honored, to be a board member at Amalgamated Bank, but I was there pretty much from the start of Keith's tenure as a CEO until he left just a few months ago. He is a real thought leader in the area of finance and of putting labor's capital to work. He is a fellow at the Aspen Institute's Finance Leaders Fellowship Program, really important grouping of people who are thinking about our financial system and how to make it better for society. And the author of Organized Money, which came out just about 2 years ago, which is a really good synthesis of the ideas around responsible investing and how to make the financial system work better for everybody. So with that, Keith, I'll turn it over to you.
Thanks, Steve. And it was great to serve at Amalgamated Bank with Steve on the board and a number of other things as we spent a lot of time post the financial crisis in 2008, really digging out of that and putting the bank in a very, very good position to really help position labor very well as a financial player. I want to take a few minutes to talk a little bit about the history of the bank, where the bank stands today, and then offer maybe a few provocative views, I think, in terms of what labor and its capital could actually do, and how we're really, despite decades of trying to build institutions, I think still failing to sort of meet the moment here in terms of what we could potentially do in the space. For those of you who don't know much about the Amalgamated Bank, its funny name comes from the name of its founders, the Amalgamated Clothing Workers of America. It's very, very forward-thinking leader, Sidney Hillman, in 1923, along with the board of directors of the union. Now, remember, 1923 is 12 years before the National Labor Relations Act was passed. And so labor organizing was not done under, much of a sort of formal legal context. It was really community organizing in its truest form and its truest sense. And the founders of the Amalgamated were building a real community of garment workers in New York City, Chicago, and a handful of other cities around the country. They built health centers and drop-in centers where workers could go and actually get some of their basic needs met. They built a life insurance company that allowed workers to be able to get basic life insurance products. They built a ton of affordable housing. Most of the affordable housing stock that dates back to the 1920s was built and financed by the union. And in both New York City and in Chicago, they chartered what at that time were one of a small number of labor banks in the U.S. In fact, the Amalgamated Bank of Chicago was chartered in 1922, and the Amalgamated Bank of New York, which is the bank that I had the pleasure of serving with, was chartered in 1923. And the bank had a very, very specific set of goals at the time when it was founded. It was built to be an institution that could provide access to the banking system that many working people did not have the ability to access. And so the first products that the bank had were really three incredibly basic products that met the needs of immigrant garment workers at the time. The first was the first free savings account in the history of the United States. The standard was that you paid the bank for the privilege of letting them have your money. They, of course, paid you interest, but you paid a fee as well for the service. And Amalgamated sort of turned that on its head. and offered the first free savings account, and then followed with the first free checking account much later in its history. They offered what was really a precursor to what became now credit cards, but they offered a very early version of an unsecured loan where a consumer could walk into the bank and with no security, no collateral, could borrow small amounts of money to meet some of those basic daily needs that people might have, whether it was to make a small purchase or finance a kid going to school well before the era of student loans, or maybe even start a small business on the side from what they were doing. And they worked with the political parties and the trade union movement in Europe, where the garment workers had emigrated from, to meet the single most important need that working people had in that day, which was to send money back to their families in war-ravaged Europe, whether that was to support their lifestyles in the countries that they came from, or to help bring them across the Atlantic into the United States. And so Amalgamated was really the bank that invented what became now known as the foreign remittance system, that really allowed people an ability to send money back and forth to other countries. And so for much of Amalgamated's history, it met the needs of working people, mostly in New York City. It wasn't until the 90s that interstate banking was really something from a commercial banking perspective that you could do. So you had to be focused very locally in a local economy, and Amalgamated met the needs of people. But lo and behold, the city of New York changed, and Manhattan, where much of the bank's physical infrastructure resided, became less and less a haven for working people. If any of you spend any time in Manhattan, you know what I'm talking about. And the bank gradually saw many of its core customers migrate to the outer boroughs and other things. And the bank followed and did some of that, but it became much harder to do that as the sort of physical concentration of the key target workforce that Amalgamated targeted just dispersed across a much wider region. And over the last couple of decades, the bank's business has really evolved in quite a different way than what it started as. And today, the Amalgamated Bank is primarily a commercial institution, although it still does consumer business for individual working people and others. There's no requirement that you be a member of a union or be a working person per se to have an account at Amalgamated. But really today, most of Amalgamated's business is meeting the commercial needs of a different kind of underserved population. And that's really the unions and the labor federations and many of the other allied nonprofits and political organizations that are allies with the labor movement today to really provide them with commercial banking services. Those organizations and the business of those organizations is quite different than the business of for-profit institutions. The balance sheets work very differently. The goals and objectives of the organizations are very different. Those organizations rely very little on the extension of traditional credit to actually support their business. That might be something we could talk about. That's something that could be met better. But the business of a nonprofit or a union is very, very different than a for-profit union. And the vast majority of this country's 5,000 commercial banks and 5,000 credit unions are either set up to meet the needs of individual human beings or for-profit businesses. And what we did at Amalgamated was really be able to build a group of bankers, very much like Randy's done at the ITC, of people who came out of the labor movement and really understood the business of the labor movement to be able to build products and services to meet the needs of the labor movement. So today, Amalgamated has a handful of different businesses. Its primary business is to provide commercial banking, day-to-day kinds of services to be able to allow people to make deposits and generate payments to pay their staffs or pay their members through their pension funds and all the mechanics that actually go into actually running any of these businesses. And Amalgamated does it with a lot of special attention paid to the needs of how those institutions actually work and function and operate. On the other side of the bank's balance sheet, the bank lends its money out to mortgages for union members to finance a lot of the permanent kind of financing, not the construction financing that Randy talked about, but the permanent financing that many commercial buildings need to be able to do that and to really take those deposit dollars and invest them into projects that are out there really helping support the labor movement in many, many different kinds of ways. The bank also has a trust department. It has a almost $50 billion trust department that does two important things. One is they offer a set of products very similar to the equity index funds that Randy laid out, just another set of flavors with different kinds of investment objectives. Some of them compete with the ITC products. Some of them are different and complementary. But also the bank provides the sort of plumbing behind how all of those funds need to do, which is provides custody services so that pension funds can actually function and operate and meet all the needs that they have, both to manage their investments, regardless of who the investment manager is, but then also to correspondingly make the payments to beneficiaries on a regular basis. It's all these hidden things that just make the clock work on that, and it's an important service that we offer to the labor movement. And then finally, what the bank has recently come out with is a new series of funds that meet sort of the need to, that many unions, but other investors have as well, which is to find investments that align with their values. Sort of the moniker of the day is ESG investments, but investments that really meet the kind of, whether it's environmental or social goals that are laid out by many evolving investment strategies that people have, and the bank recently introduced a family of those funds as well. The bank is a for-profit institution. It is vibrantly profitable. The union that founded the bank still is the largest shareholder of the bank today. The bank did invite some other capital in to help recapitalize the company after the financial crisis, and to help the company grow. The bank is growing from its roots in New York. Bank now has full-fledged commercial offices in Washington, D.C., San Francisco, and in Boston, and is meeting many of those needs. And the bank is vibrantly profitable, pays a dividend back to its shareholders, the primary beneficiary of which is the union that owns 40% of the outstanding stock of the bank today. So that's a little bit about who Amalgamated was and who Amalgamated is today. It meets a pretty important need in the ecosystem. But at $6 billion as a commercial institution, just as a comparison, a company like Chase is $1 trillion institution. So while Amalgamated is a sizable enough financial institution, it's quite small when compared to its competitor, its principal competitors in the marketplace. And at $50 billion of investments under management and under custody, I mean, that's a drop in the bucket from what Steve said. If there's $4 trillion of worker capital that's really out there invested in multi-employer pension funds, public funds, and other kinds of funds. So I think the challenge is, and I think one of the things that labor's capital really needs to question itself really hard about, if there are $4 trillion of assets out there on the pension side, and a couple $100 billion between international unions and local unions on the sort of day-to-day operating capital that those banks have, and millions and millions of annual transactions that happen, that are making a whole lot of other people in the system pretty rich by processing those transactions. Why, after so many years and so many decades of, a variety of different financial institutions that have been created by the labor movement, whether it's the Amalgamated Bank or ULICO or the ITC or Union Privilege and Union Plus, and some of the other labor banks, and even some of our credit unions and things that have been established, why is the vast majority, and I mean 98% of labor's capital, actually not in its own institutions? It is actually spread across the financial marketplace, often in a number of institutions that are many times, whether it's in the political ecosphere or just in the day-to-day, labor and management battles that we have. That money is often sitting on the other side of what we want to do, and I think the real challenge here is to sort of say, how do we stem that tide? In this business, and Randy, I know, was going to shake his head on this, size actually matters. It's very hard to do things. Small might be beautiful in some ways, but in finance, it gets you nothing. And you really need to build big institutions that can do things. And I think the challenge continues to be to really figure out both how the institutions bring a better offering to their labor customers, but also how labor becomes a more dedicated and valuable customer to build larger and bigger institutions. We need more of them. It's not just to build the existing ones that we have. We probably need more, but there's so much we can do if we just decide to harness our own capital and put it to work for ourselves. And with that, I will sort of stop and make sure we have some time for questions.
Yeah, that was great, Keith. Thanks so much. You know, one of the things that, well, a number of the things that Keith did when he became CEO of the bank is that he built a super competent team around him, really great folks, bought a bank in San Francisco, took Amalgamated public, which was a torturous event for anyone who has been exposed to the capital markets, but it has survived. And it has survived, you know, two private equity investors being at the table, and I'm proud to be one of them. And I don't know if Rose Bat is on the, but she's a critic of private equity, but this is an example of where private equity has done a lot of good. And that is a good segue to Tom Croft, who is the executive director of the Steel Valley Authority, has been for many years, and also the managing director of the Heartland Network, which brings together folks who are interested in these topics of labor's capital. Tom is the author of many books on this subject, and has really led Heartland into some really interesting new activities that he'll tell you about, including, you know, looking at the role of selecting private asset managers who do the right thing rather than strip it and flip it. So with that, Tom, if we can get you in there in about 10 or 12 minutes, that would be great. Folks, if you have questions, put them in the chat room, and I will call on folks as soon as Tom is done. So Tom, it's all yours. Take yourself off mute.
Thank you. Thank you, Steve. And thanks to Alira, and thanks to my co-presenters who I'm honored to be here with today. And also just need to give a shout out to Steve, who's been our co-chair of the Heartland Network for the last several years and has really helped us to move to another level. So I wanted just to talk a little bit about who Heartland is, but also a little bit about following on what Keith has talked about. A little bit of the labor history of labor's capital, as well as today, looking at the reach of the Heartland Network and union-friendly investors, not just across the US, but across the globe. So real quickly, the Heartland Network was formed back in 1995-96 with the help of Leo Gerard, who was the Secretary-Treasurer of the Steelworkers at that point. And the Steelworkers had a very much more aggressive point of view in terms of dealing with the corporate restructuring that was going on in the 1980s and 1990s. And for many years, they were actually hiring investment bankers to help them intervene and engage in those corporate restructurings for a better outcome for workers and for American industry. But the mission of the Heartland Network, as we envisioned it, was really in something of a counter to the legacy of the 1980s and 1990s robber barons and corporate raiders. And we learned that many of those folks were using workers' capital, were using pension funds to invest in sweatshops, to destroy companies through stripping and flipping companies, and also doing a lot of sending amazing amounts of money into mergers and acquisitions, which generally over the long run lost money and wound up hollowing out millions of jobs in American industry. And so we wanted to bring together a unique table, and that's what we began doing, bringing together the capital stewards of the pension funds, of the union pension funds in America. And so we brought together pension leaders, asset managers, labor union folks, and pension consultants and other academics. And we began to ask the question, how can we mobilize the responsible investment of workers' capital through investments in the real economy? which would achieve competitive returns, but also have positive jobs impacts. And so we began that that process, many years ago, and wound up putting out our working capital, The Power of Labor's Pensions, which came out in 2001, was published by Cornell.
Hey, Tom, you're sort of fading out on us. Could you, you may have to take yourself off of the video and just talk. Just take yourself off video because your internet connection must be slow there.
Sorry about that. Am I back on?
Yeah, you're back on, yeah.
Sorry about that. So I'll get to the point where we launched Heartland and the specific goals of Heartland, but I want just to give you that short background, because the history of labor's capital, of labor unions investing responsibly for their members and for people in society, goes back a long ways. And in one of our most recent books, we learned that labor unions, for instance, in the Netherlands, were investing in social housing in the 1850s, sort of the Industrial Revolution. Europe and Australia were investing in social housing. I'm not sure what's going on. We might have. I'm down here in the Outer Banks almost.
Yeah. Hey,
So,
hey, Tom.
yeah,
Tom,
yeah.
try doing the stop video and then just talk, because sometimes that can speed up the talking part. The
Okay.
connection. Yep.
Okay, I'll do that.
Yep. Go ahead.
All right.
We can
All
hear
right.
you.
So, all right, I'll try that again. So, so the kinds of things that Keith was talking about that was happening in New York City in the 1920s, those same activities, labor unions were leading those charges back in the beginning of the 1900s, setting up credit unions and banks and co-ops and social housing and mutual aid societies. And then, of course, during World War II, European unions were very much instrumental in helping to rebuild Europe after World War II. In the United States, of course, a lot of those kinds of activities started up in the 1920s in New York City. And then in the 1960s, AFL-CIO President George Meany met with Martin Luther King, and they basically came together to talk about how could labor's capital help rebuild American cities in the 1960s. And you had that great, essentially, establishment of the Housing Investment Trust and the BIT and other institutions under labor's banner. So in the 1980s, as the industrial unions struggled with restructuring and massive deindustrialization, there began a conversation as to how can industrial unions begin to do the same thing? How can industrial workers, steel workers, machinists, auto workers begin to use their capital to rebuild an American industry, which was being divested in by Wall Street at the time. And so we began working with a number of the investment banks that we had worked with, the steelworkers had worked with, and around the time of our first book, we were able to help many of us working together, many of the unions working together, commercial unions, service unions, industrial unions. We were able to help launch a couple of new investment vehicles that were committed to investing in American industry, but doing it in a way that protected our values and protected union jobs. It turned out that as time went on, many new investment vehicles got launched, more housing vehicles got launched. And then we watched in the 2000s as teachers and public and service employees began working with public pension funds to invest in new energy investment ideas, infrastructure ideas. And we saw the growth of those vehicles over many, many years as well. So now today, the Heartland Network is comprising several dozen investment houses that are, some are name brand AFL funds, but others are committed to labor union voice. And And they're investing in ways that are transforming the world. They're investing in smart and efficient buildings and affordable workforce housing. They're investing in wind and solar farms, a whole new sort of era of community scale infrastructure. They're investing in high-speed rail and electric and hybrid buses and cars. They're investing in advanced manufacturing and broadband and emerging technology. And most of them are working to ensure that their investment provides a voice and partnership in how companies operate. Now, there's some specific ways that these investment groups have worked to ensure that those investments will follow our values. And many of them have utilized in the construction and in the infrastructure space, they've used a responsible contractor policy. And when they have worked with cities or states which are out there, issuing RFPs and procuring construction projects or new energy projects, they're working with the cities and states to establish project labor agreements. And those are strategies which will more or less guarantee that the projects will become union projects, and which then also provides a pathway for apprenticeships and for young residents of our inner cities to find decent careers and decent jobs. Responsible contractor policies essentially provide language on wages and worker health and safety and manager neutrality and training and apprenticeship programs, and that can protect the rights of workers who are hired by firms that are occupying the building after construction is completed. So part of the construction can be union. Some of the activities of a facility that's been constructed can also be union by using responsible contractor policies. So Randy's fund and HIT and MEPT, many of the other funds out there use that process. And you're seeing ULICO and many of the other folks using a similar program in terms of these new infrastructure projects, which are really coming into America. These wind projects and solar farms, new energy projects are coming really strong across America. I'll say one more thing about how worker-friendly private equity funds are operating, and that is most are using neutrality clauses. So when they are going in and in many cases turning around companies that otherwise would be bankrupt, they're utilizing a process so that they can ensure that the union stays on the job and that those workers have collective bargaining rights. So those are the kinds of trends we've watched. We have watched as we've documented the construction of hundreds of thousands of affordable housing units. We've seen hundreds of thousands of jobs being either saved or created in financed investment vehicles or union-friendly vehicles. So we have a long way to go, as Keith says, but
Tom, we're losing you, and I think there was an important punchline there. Can you just sort of give us the punchline again?
Yeah, I was just saying, and I apologize again for my lousy bandwidth here. As Keith has mentioned, we have a long way to go, but we're now working with pension consultants and union pension funds and public pension funds all across the country, Democratic treasurers, mayors, to move this ball and move this agenda and help rebuild America. So thank you.
That's great, Tom. Thanks so much. If Tom had a little more time and better bandwidth, I think he would have talked also about one other project Heartland is doing, which is we've created a fellowship program where we're taking college students and matching them up with people, institutions in the responsible investing world. So
Right.
There's fellowships at HIT and at a number of the private equity shops, and the consultants to the pension funds and several pension funds and unions themselves. So I think we have 11 fellows this summer, Tom, is that right?
We have 12 this summer.
We have 12 coming in this summer, and they get a $6,000 stipend, and it's a really great experience for college students who are enthusiastic, but not aware of either labor or progressive capital. So it's a real learning experience for all of them. And it's a ton of fun to see the next generation coming along. All right, so we got a couple minutes here left for some dialogue. Dale Bellman, can I call on you, because you posed an interesting question in the chat, and if you could just sort of frame that as a general question, that would be great, because I think that is a very important question, particularly given your background in doing research on the construction industry. Randy Dale is sort of the resident expert in LIRA on construction issues, so he's a very important voice to listen to. Dale, go ahead.
Okay, Randy, this comes out of some experience, but I won't cite the exact one, which is a developer basically is interested in getting financing from the trust and is also interested in developing in a heavily non-union area. And let's say they've also taken the position that they would be happy to sign a PLA and so on. What do they need to put together to come to one of these trusts to pique their interest and possibly even work things out?
Hey, Dale, and thanks for asking the question out here and instead of in the chat. So specific to the Building Investment Trust as a core real estate investment fund, again, we're the equity partner in these. The BIT is the equity partner in their investments, and you're looking at, frankly, in these bigger cities where you don't always have to do a PLA, right? There's a bench of union contractors that you can work with, and what that gets to on our side of the world is it's wonderful that we're doing this in Chicago, and I'm going to be frank because we're all friends here in this room that no one's writing this down, right? But
we're recording it.
We're recording it, but we're not going to share with anyone anyway. But no, I think the question we get all the time is, this is wonderful, but what can it do for me in an area where I do have a contractor who wants to get right with the world? How about that? And in an area where building market share is something that that could help. Obviously, we can help anywhere. Right? So I'll say this: the ITC, where I work, and the building trades are looking at creating new vehicles and working with other managers on something separate from what we've already done to take advantage of areas where there's exciting growth happening, where there are contractors who want to find ways to work with labor, who recognize that if labor's bringing money to the table, that it's just as green, as I joked earlier, but also who see the benefits. We've talked to over the years lots of national builders who, as we say in the industry, kind of are double-breasted, who will work in their home cities, 100%, and then go to a Charlotte or an Atlanta, right, and work with what they've got down there, who often are bringing trades with them from Chicago or from other places, because they recognize that they're going to get the job done faster, better quality, and will pay the union rates because it's worth it, right? So to answer your question in a long way, there are more opportunities coming, right? I would say if there's a contractor in a particular area who is looking for a project, looking to get involved and wants to take advantage of a project, please always share stuff with me. I put my information in there, and I can perhaps find ways that we can link them up with some other like-minded institutions and groups, and link them up with that local, the right folks in the local area, in that area, from the appropriate crafts, right, to see if we can't figure some things out on some projects that are looking to go. But we've found, again, in our research recently, is that there are more contractors like the one you're talking about, who would love to work with labor, especially now, and who are looking for opportunities to do so. It's just the BIT is not always the perfect vehicle for it, but there are.
Yep.
Hey, Steve, if I can just hop in there too.
Sure.
I think Dale's question just points up one of the absolute needs why you have to have labor capital in these markets, because Randy talked about the equity side of the equation on these projects. You think about the debt side of the equation on many of these projects, a project in a traditionally non-union environment with a PLA is going to face a set of underwriting challenges from a debt underwriter, because they are not going to want to see that they're going to see that as a detriment to the potential successful completion. I'm not saying I agree with this, but they're going to see it as a problem for the project getting done or leading to cost overruns. They're going to underwrite the project more tightly. That's going to result in more expensive financing that has to come on the debt side of the equation. And unless there's somebody in there explicitly with a labor lens and a labor perspective on it, all the other capital is going to have a lot of intention to want to make sure that that kind of agreement is not in place in that project, actually. And with most markets being predominantly non-union now, that is another barrier to, I think, contractors who might want to do the right thing being able to find debt financing to be able to do their projects.
Yeah. If you have a question, just jump in here and raise it now. I will. I'll turn it back over to Tom just for a second. Tom, can you just take a minute? It seems like your connection is back. Just talk a little bit more about the fellowship program and the connection with Georgetown and Kalmanovitz and how that came about.
Right. So we're actually working with Georgetown as our home university. The Kalmanovitz initiative, which has now been around for about 10 years, which has been doing a lot of labor educational programming. At the university. We're also working with probably another 24 universities around the country, and we're recruiting business students and labor students and economic students and finance students. We're trying to give them an alternative to Wall Street, so they're not just going to Wall Street and sitting at a trading desk. We're also trying to diversify the pipeline for the financial services arena, and that includes not just investment houses, but we've also expanded our program. We're now working with unions to work on shareholder campaigns. Our investment houses are teaching students how to turn around companies, build affordable housing, build windmills, build solar projects. And we're working with a number of national policy institutes as well, including recently the governor of California, on many of the problems they're facing the climate issue there. So we'll be graduating 30 students a year now, and thanks to the help of Randy and ITC and many of our other family of funds, we think that this program eventually, over the next few years, will graduate another 100 students.
That's great, and I will make sure for the academics in Lyra, I'll make sure that we get the announcement about the fellowship into the Lyra network as well, so that if you have any students, this is targeted towards undergrads. We've had a few graduate students, but it's really targeted to the folks between their sophomore and junior, or between the junior and senior year. Any questions? Any last questions? We have one more minute. All right, so I'm going to, seeing no questions, I'm going to just ask for just a closing thought from each one of you. Randy, what would you like to leave the audience with the main thought that you had today?
I'd just say, and I was thinking about what Keith was saying, we have vehicles out there, right?
Right.
But we're small. I think we used to use a metric of how much of that 4 trillion, or whatever the number is now, of labor's capital is actually invested in vehicles like the ones we've all worked on, and it barely makes a mark. I'm not complaining about that. I mean, I think we need to do a better job of telling our stories and getting these things out there. But we always ourselves start thinking, imagine if we had 2%. 3% of that money. So, I'm excited that we've got new vehicles coming, and there's lots more interest coming, and there's new vehicles that are being created through Congress and other things that are going to allow us to do more things.
Yeah.
But we are just at the beginning. I mean, it's still, after all these years, we still have just barely kind of cracked the surface. So I guess hopeful, but also kind of,
Lots of opportunity.
So,
Keith?
Ditto to Randy. We talk about institutional money. Think about what if we added all the individual union member money into all that too, and how big our capital really is.
Tom?
And I would just say, we're far behind the curve in terms of following what looks like is happening in Europe. And Heartland has been working with Congress and Andy Levin to essentially establish and launch the first Sustainable Investment Act for America, where pension funds will have to pay attention to E and S and G, but also be able to reinvest in economically targeted investments.
Fantastic. Really super. Thanks so much for your insight, and the audience participants. Thank you for paying attention. Thank you for you taking an hour out of your Tuesday afternoon.
Thank you. Thanks, everyone. Thanks.
thank you.
Take care. Great session.
Thanks, Steve.